Every single night while most of us are sleeping, over $2 trillion quietly vanishes from the financial system. It's not stolen and it's not lost. Instead, this enormous sum is simply parked somewhere out of sight. The vast majority of people have no idea where this money goes or why it disappears so routinely. This nightly ritual is part of one of the strangest and least discussed mechanisms in modern finance, the reverse repo market. Think of it as the hidden plumbing that keeps the financial world running smoothly, even if it's rarely talked about in the news. But what exactly is happening behind the scenes, and why does it matter so much? Let's break down what's really happening. Banks, money market funds, and other financial institutions are currently sitting on massive piles of cash, so much in fact that it's become a problem. In the world of finance, cash can't just sit idle, it needs a safe place to go. Right now, the safest home isn't a savings account or a corporate bond, it's the Federal Reserve. Every night, these institutions lend their excess cash to the Fed. In exchange, they receive Treasury securities as collateral. Next morning, the process reverses. The cash comes back and the securities return to the Fed. This cycle repeats every single night. It might sound technical or even boring, but the sheer scale is staggering. At its peak in 2023, the reverse repo facility held over $2.5 trillion every night, more than the GDP of Canada, locked up and out of circulation. Why are these institutions parking so much cash at the Fed? The answer lies in years of money printing and economic stimulus, which have flooded the system with liquidity. With so much cash sloshing around, even a low interest rate at the Fed is the best option available. But here's the uncomfortable truth. This isn't a sign of a healthy system. When the safest move for trillions of dollars is to remove it from the economy every night, it signals a lack of trust in the system itself. Reverse repo facility was originally designed as a short-term emergency tool, a way to manage liquidity during crises. But it's been running at record levels for years, turning a crisis tool into a permanent fixture. As the Fed raises interest rates and drains liquidity, the reverse repo balance is finally starting to fall, and trillions are slowly re-entering the economy. Now comes the big question. What happens when all that cash stops disappearing every night? As trillions of dollars look for a new home, the financial system faces a new set of risks. Assets can inflate rapidly, risks may be, and bubbles can form in unexpected places. The reverse repo market acted as a shock absorber, quietly soaking up excess cash and keeping things stable. But as this facility deflates and the money returns to the market, unpredictability rises. The real issue isn't just where the money goes each night, it's what happens when it comes back all at once. The financial world is about to find out.